For sure. He was he started investing with Hamilton Zanze when they first started, right? So he got my foot in the door and from there. So it's a great thing to teach, and I think it's an exciting market. So I hope I can teach my kids the same way my dad did. So yeah.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Agostino. Scaling your real estate portfolio is crucial to ensuring the continuity of cash flow, reducing your expenses through economies of scale, and of course, ultimately achieving that financial freedom you're all looking for. Now, who knows, maybe you're willing to grow your real estate business, to scale it up to a point you want to go beyond 10,000 units. Maybe you want to take it public one day. But it all comes down to first putting in the processes in place today to get there. Now, our next guest understands all this. Now, she started her career as an intern 10 years ago, working in real estate, to becoming now the CFO of Hamilton Zanze. They're a real estate firm with a portfolio of over $4.3 billion under management. Now, the company is one of the nation's largest privately held multifamily syndication companies with over 20,000 apartment units under management. Now, with all that, I'd like to welcome Ashlee Cabeal to the show. Ashlee, thanks for coming on.
Thanks for having me. I appreciate it.
Yeah, I think it's going to be great. Been looking forward to this for a while. Now, if you like what Ashlee has to say, you can reach her via her contact page at hamiltonzane.com. Okay, Ashlee, go ahead and tell the listeners a little bit more about you and how you got your start in all this.
Yeah, so I joined Hamilton Zanze just over 11 years ago. I started as an intern. I was getting my graduate degree, my MBA at UC Davis, and I took an internship at a real estate firm. So prior to that, I was at PricewaterhouseCoopers as an auditor. I had no idea I wanted to get into real estate, but my dad actually had our family starting to invest in real estate when I was a little girl. So when I was thinking about internships, he said, why don't you try real estate? Learn about it. Your family's invested in it. And I was like, I'm not interested. But I took an internship and here we are 11 years later. And I love real estate. So all the pieces fell into place. When I started Hamilton and Zanze, it was a lot smaller than it is now. We like to call ourselves a friends and family shop, and we still are. All of our equity, or at least 90% of our equity, comes from our private platform of friends and family. But we have grown. We've grown a lot over the past decade, which has been really exciting to be a part of that growth.
Excellent. Now, take a step back to your family first. It's kind of curious because I'm doing the same thing for my son. I get him exposed to as many real estate deals as I possibly can. We're actually in the process right now of getting our hands on some debt for the Rockefeller deal. And I actually have him listening in on some of these phone calls. So was that the same sort of thing for you? Was your dad really trying to include you in things like that? Was that happening back then, or did that happen a little bit later in life?
I would say it happened a little bit later for me. So growing up, my dad, he took a similar path that I did. He got his degree in accounting, kind of went into the public sector of accounting, went to go be a COO of a manufacturing company. And then later in his career, he went into real estate. But as he was working these other jobs, he was incrementally investing in real estate where he could, right? Where he had some money saved and he would buy deals or partner with people to buy deals. So it was always in the background, but it wasn't his full-fledged career until later in life as he was building his portfolio and his retirement. And it was a big piece of that. Growing up, I always loved numbers and, saw my dad doing numbers. And so that kind of fit. I got my degree in accounting. I grew up in Silicon Valley, so I thought I was going to go work in private equity or VC and do that whole gig. But, when he suggested real estate, it kind of fit. And what I love about real estate is that it's real. It's tangible. You can see it. You can touch it. That part really kind of resonated with me. And I think that's why, you're bringing together the numbers and kind of that tangible factor, why it's fit so well for my career to date.
That's awesome. I mean, that's one thing that in the case of your family and mine, of course, is that there's a legacy there, right? He was able to pass on a legacy to you, even if it is knowledge. And I'm hoping I can do the same thing for my family. So that's great. So
For sure. He was he started investing with Hamilton Zanze when they first started, right? So he got my foot in the door and, from there. So it's a great thing to teach. And I think it's an exciting market. So I hope I can teach my kids the same way my dad did. So, yeah.
Excellent. That's awesome. That's awesome. So let's talk a little bit about the type of assets you guys have today. So I know today you guys have 20,000 units. Let's talk a little bit about what sort of assets are you guys buying? Are you buying nationally? Are you targeted in certain areas, to certain markets, that kind of thing?
Yeah, good question. So when Hamilton Zanze started back in 2001, so it's 20 years, it was primarily the Western United States. So the three principles are from here. And the original premise was we want to be able to travel to the real estate and back in a day, right? We have families and want to be able to fly. So, started in Washington, Oregon, Nevada, Arizona, kind of those markets. We've actually never owned, well, not never, but we haven't owned a multifamily deal in California for 19 years. So we actually don't invest in California, even though we're based here. Now, all these years later, we're invested in 15 states and 29 different MSAs. So, if you looked at the United States and made a smiley face, that's kind of how we're looking right now, skipping over California and a couple of the other states, but Western, and then we're building on the Eastern Seaboard right now. In 2016, if I remember correctly, we bought our first property in Atlanta, and that was kind of the springboard for us to start building a portfolio in the Eastern United States.
Nice. Now, are you buying like value add type of assets, stabilized assets, A's, C's? What sort of assets are they?
Yeah, so we're typically a value add shop. So that could be B properties that we're doing CapEx work, and that's what we call value add, or it could be taking over for a management company where we think we can add value add, right? We may be able to manage it better. So value add, I'd say core plus. Traditionally, we were in secondary markets, but now we're looking in more core plus markets. It kind of depends on the story and who we're buying from and where the asset is located. Once we buy an asset in a market, we like to grow that market to kind of create those economies of scale. It's a lot easier for us to manage, 3 to 5 assets in a market than it is for one asset in that market. So once we make the decision to enter that market, we want to enter it and not just do a one-off purchase. So a lot of research, kind of beforehand, before we say yes to that market happens. Then when we say yes, we're all in. Let's go buy more and build our portfolio in that market.
It's funny because that's a strategy that I've employed. And so my partner has done the same thing as well, right? So it's like we pick one market and we invest heavily in that market. That's it, So, and I never quite understood how people are able to they'll buy, just like I said, a one-off in Nashville, another one-off in North Carolina, like 100 units here, 200 units there. I don't understand how they make any money at that. I just don't get it. There's no economies of scale. Yeah, it's hard.
It's hard. Yeah, and we've, strategically chosen to exit markets, right? Because they have been difficult for us to manage in, and we haven't been able to really see the growth that we thought we were going to, or maybe it's traditionally smaller assets that are in that market. So strategically, through our history, we've decided to exit markets too. So you have to think about that stuff too. If that market is not performing as it should or what you expected, it's okay to exit, right? It's okay to sell and deploy your capital someplace else. It's a hard decision, but it ultimately probably will prove out to be a good decision.
Hey, Agostino here, and I would love to connect directly with you. Text the word books to 202-410-4202 to receive weekly book recommendations from me.
Right. So maybe, and let's dig into that too. So, you saw most of this growth. You were there for it, which is great. So what sort of things did you have to take into account then when you're making that leap? I think the company's about 20 years old. You're there for 11 of those 20. So you saw some of the leap that took place. It sounds like they were doing 1,000 units a year, right? So they're probably at 8,000 units when you joined or something?
No, it's funny. So we've actually, total asset or total units that we've purchased over our history is about 42,000 units. So we've sold about 21,000 units as well. So when I joined, we were coming out of kind of the Great Recession, right? It was starting to pick up. Acquisitions were picking up, equity was coming back. And we decided, kind of in the next coming years, we wanted to reposition our entire portfolio. So we kind of took, a more disciplined approach in our acquisitions. What kind of properties were the strongest performing for us, right? We found that we managed 200 plus units better than we did under 200 units, right? They were harder for us to manage, harder for us to figure out the staffing. So we also like rents of $1,000 per unit on average, right? That was kind of our sweet spot for us. So kind of these decisions, it took us time to build out that, loose structure in our acquisition and underwriting process to determine, okay, we're going to sell, this 112 unit property that we own in Spokane, and we're going to exchange those funds into a 200 unit property in Phoenix, Arizona, right? And kind of reposition our portfolio to kind of hit these benchmarks that we're looking at, whether it be vintage, how old it is, size, average rent per unit, location. So we kind of repositioned our portfolio, and bought bigger properties, I would say on average, newer properties on average, and kind of really wanted to get our portfolio in a good sweet spot for us where we thought, we were the best managers that we could be.
It's funny because you're defining everything up front, and then you're chasing after it. You're going after those sorts of deals. So, and again, it sounds to me like many of the assets that you have now that you're targeting now are at least even before anyway, they're a little bit more upmarket, right? They're not just like your typical crappy C class. No offense to the guy. I mean, I buy that stuff too, right? So.
No, it's not. No, yeah, C class isn't. We were there, right? We did own C class, probably not a lot, but B minus, right? Kind of on that verge, and we decided to take our equity and, we call it 30 years or newer, right? So when we're looking at something vintage wise, 30 years or newer, I'm not saying that it's hard and fast, right? If there's a 1975 property that kind of hits the mark, we may chase it and we may buy it, but kind of those parameters as an initial checklist during that acquisition process, we're kind of looking at all those things. And I would say that checklist was built just based on the experience of our partners and our leadership team, right? Majority of the people that have been at Hamilton Zanze have been there for a long time. Mark, Tony, and Kurt have done a great job bringing in young people, teaching them real estate and letting them go out there and execute and build and make the company better. And so all of that experience comes together in kind of this great investment process and investment committee process. And, our managing director of acquisitions is great. Right. And he finds great deals for us and we're able to execute.
Right. And what's interesting is that it sounds to me like I said, like you said too, yeah, sure, maybe you start off with the C stuff, but then you're going up market and now you're building a brand and you're defining what those assets look like in that B asset and you're staying in that band, so to speak, right? Like you're looking for certain rental income, you're looking for that upside. And you're only targeting very specific markets. And that part is huge because, like we said earlier, it's tough to grow a business when you're all over the place. And I think it's also a challenge to try to run those assets too. I mean, what I like to say to people is that it's easy to buy an asset. It's hard running it for 10 years profitably. That part is extremely hard. And it sounds to me like you guys have that part nailed down.
Yeah, we're learning as we go. I mean, but yeah, we've got a pretty good system. And every real estate deal is not going to be a home run, but doubles and triples are great as well, right? So, and we want to be as strategic as possible. We want to grow, right? More assets under management is great for us as we continue to build our portfolio, but we want to do it in a strategic manner.
Yeah. Now, so tell us about how you guys manage your assets then. So if you do decide to say get into a new market, are you employing your own management company? Are you guys going in to buy a management company or do you go third party for a while? How does that look?
Great question. So Mark, Tony, and Kurt, along with Pat Hutchison, started Mission Rock Residential in 2012. So we saw the need to kind of have our own management company or one that we work directly with. Prior to that, we were using a bunch of different third-party management companies depending on the market that we were in. And they were great, for where we were at that time. But the thing that we struggled with is, we weren't always aligned. And we wanted our management company, they're our boots on our ground, right? They're there every day at the asset. As asset managers, we cannot be there every day at the asset. So we want them to run that property like it's their own business and want them to understand the business plan from our side, right? Since we're representing the investors. So Mission Rock Residential was started, and they manage our entire apartment portfolio across the United States. So if we're going into a new market, Mission Rock is aware that market we're going, so they need to start growing their team, right? They need to figure out who's going to be overseeing from a regional operations side as well as a regional maintenance side, right? So they're figuring out how to staff that boots on the ground stuff as Hamilton Zanze continues to build their portfolio. They also have third-party clients, right? We're not their only client. They've grown that bandwidth as well. But for us, they are our management company for all of our apartment complexes. The one thing that was great when we brought Mission Rock on is that now all of our data was with one property management company. We weren't, using different property management companies. Some may use Yardi, some may use different accounting software, and all of our data was all over, which was hard for us to really digest and kind of dive into the trends that we were seeing at our properties to help us figure out that we wanted 1970s and newer, right? Or whatever it was to help with those metrics. So getting our data on one platform was really important to us.
Yeah. And that part in itself is huge too, because again, I'm not entirely sure how people try to manage these different assets and operate them across a country using different platforms, different people, non-integrated. It sounds to me like a nightmare, honestly. I mean, I'm personally very happy that we have one group that manages our entire portfolio here, and they just do a great job. And it sounds to me like you guys just employ the same sort of model, which is great. So now, how do you guys manage your KPIs then? Like your key indicators that show that you're really performing and hitting all the marks. Are you guys doing like a weekly meeting? Are you guys doing monthly? How does that look?
Yeah, so every 2 weeks we get a weekly report, kind of saying how the property is doing. We also have an asset management team that's diving into the financials, every month as they come out from the properties, making sure our cash flow is kind of hitting our benchmarks. And then every year in the budgeting process, we're reviewing how the property has performed to, what we project for the next year. So those KPIs, with all that data in one place, we are getting so much better reporting, right? Because we can compare our average payroll expense in this market to the next market, right? And we're able to use that. I think the other thing to keep us honest is that we're also in these markets underwriting, right? So we're seeing how other apartment management companies are performing in the same markets that we are. And so if something is off, we're going to see it, right? Because we're pulling expense comps from our own portfolio as we're underwriting, and we're looking at the same time at these properties, and we're like, wait, something is off here, right? So it's constant communication between us and Mission Rock, and we're constantly in the market. So we have multiple data points that we're able to use to kind of keep us in check on the operations side.
Interesting. So I imagine you're using Costar, obviously, for that, right? I mean, they're the ones that
we do use Costar, yeah, and we have a market research team. So we also, yes, I would say functions like Costar we're using, but also we get a P&L for every deal we underwrite, right? So we get true operational data. And so if we're underwriting a deal in Atlanta, we see that deal. We also pull our expense comps for the properties that we own there. And we're like, wait, why on a per unit basis are we so off in these different categories? Or we're right in line, or, those kind of conversations are good to have.
Right. And well, I think it also helps define if, let's say, for instance, to your point, let's say that, I don't know, there's one of these expense items that's maybe normal. And now that's also setting the benchmark, to your point, that's what you have to beat now, right? So maybe through relationships, or you have some economies of scale in that market, maybe you can get, I don't know, flooring for a far less rate at Home Depot because you have a national account with them, and you're able to save 50 cents per square foot or something. I don't know, right? Maybe not that much. But
100%. 100%. Creating economies of scale, you can't say enough about that. Even in local markets, like, yes, on a national scale, like having a Sherwin-Williams relationship, or we're at HD Supply, whatever it is, that's beneficial. But it's also the local suppliers, right? Sometimes we find, like, if we're doing unit upgrades, finding that local contractor who is in the market is sometimes going to be better for us than kind of a national group that's bringing subs in and all that stuff. So being able to maybe take that vendor once we find him or her and move them to the different properties as we're doing our value add, when those situations come about, we try and take hold of those.
Yeah. But I think that's huge, though. I think the great thing that you guys have is you have an integration point between the syndication setup and the property management setup. And because there's ownership there, you have a little more, how should I say, priority. Maybe is probably the right word for it. But you're able to basically direct them on a more, how should I say, personal level, right? Whereas you have third-party management, And even if you are the majority client for them, they'll still do what they want to do, right? But in your case, I think that ownership really, really helps. It sounds to me anyway.
We're on the same team, right? I mean, when it comes down to it, we're on the same team, right? And so they know our business plan. We're going to be straightforward with them, right? We're not going to say, hey, we're coming in and owning this for 10 years. We may say, look, this is a 3-year hold, or this is a 5-year hold. We need to go in and do all unit upgrades in 24 months, and then we're selling this deal, right? And I think that transparency really helps, with the relationship. And they also know our investors, right? They come to Hamilton Zanze's events, and they know the people. They know, they know my family, right? And we're an investor. And so I think that is really helpful in pursuing the same goal for our apartment communities.
Yeah, that part is absolutely huge. Yeah. So now, at what point? Maybe, and I know you said this earlier, that they built the property management firm. How many units would you guys say, or how would you say that they were up to before they decided to make that decision?
Gosh, this is probably me guessing, but we were probably around 9,000 units, 10,000. Yeah, maybe a little bit more, but probably right around there. Yeah.
Yeah, I mean, you have to have a critical mass before you do your own. So, but I would imagine, even if you're on your way up, you still want to have those tight relationships with property management. Maybe you won't be able to get access to the type of data that you guys are doing, which I think is absolutely huge. I love that, because doing those comparisons to see how your property is doing versus the market, even go so far as like having people check the rents in a local market. And are you below market? Or are you above market? Are you at market? Where are you at? I mean, those are the sorts of things that property managers don't always look at. They just don't. They just do a gut check. Many people do anyway. So there's a lot that goes into the operational side of things, and it sounds to me like you guys have that part covered quite well.
Yeah, so I'd say before, like if you're up and coming and you're growing a portfolio, right? Like as we were, we tried to stick to 3 property management companies, 4, right? And tried to, if we were in one market in Phoenix, we had one property manager in Phoenix, right? We weren't spreading out to different companies within that market. We tried to stay focused in that market to a strong property management company, so that at least we had that, economies of scale in that market, and had our data for that market in one place. So, and then, when we had a massive units that we could turn to a property management company and hopefully be profitable, right? For that management company, we moved over to Mission Rock, but it's not like it wouldn't work without having property management at one company. I think you just need to be strategic in, how many relationships you have, because, like our asset managers are on the phone every week with the regionals, right? And to be able to talk about one portfolio of properties with one regional is great. If you're talking to 3 or 4 different companies in one market, I think that gets hard. And it's not beneficial, I feel, to your portfolio to do that.
Absolutely. No, you're absolutely right. You're absolutely right. Now, when it comes to asset acquisition, that is probably one of the biggest things that are in many people's minds right now. And you already mentioned the gentleman there that does acquisitions for you. What sort of strategies do they employ to get these sorts of deals? Like, how do you guys source your product?
Yeah, it's a good question. So before I took the role that I'm in now, I got to work in transactions. And I loved it. There's nothing greater than the feeling of an acquisition, right? And closing that deal. So I'd say the biggest strength that we have at Hamilton and Zanze is our reputation and our name, right? So we take the time to go build relationships with brokers and with sellers in the market, in the apartment community, and we execute. We do as we say, right? If we're going to go under contract, and we try and do as much due diligence up front, so we're not coming in when that DD period expires and retrading, right? We don't play in that game. We try and do as much upfront to know as much about the asset before we say we're going to buy it. We're on the ground meeting the brokers. We establish relationships with sellers, right? So if seller wants to sell an asset and they want performance as their top priority, we hope that we've proven ourselves, and they'll come to us and say, hey, if you can close in 90 days, this deal is yours at this price, right? And if the seller comes to that, we're going to take it seriously, we're going to underwrite it, and we're going to get back to you. And if we can't hit it, we're going to say, hey, we can't hit it, and go from there. So it's all about relationships, right? It's doing the right thing, being there, showing up, doing a lot of due diligence up front, and closing.
And it's funny because those are many things that we do. We don't retrade. We don't about the price or whatever the case may be. It's either we do it or we don't do it. And that stuff it speaks volumes to the integrity of the company. And also, I think more importantly, the brokers appreciate it as well. That's how you win deals. That's exactly how you win deals. And I think many people underestimate that.
Yeah, I mean, it takes time. I would say it takes time in every new market we go into for us to introduce ourselves to the brokers, right? And make sure they know who we are and that we do what we say. So, sometimes there's some ramp up to the market, right? It took us a lot of years to buy, and Texas was a market that we struggled with. Atlanta, and we also had a seller who was selling to us all the time and kind of took us to a lot of markets as well. So those direct relationships with sellers as well were so critical to our success, right? Because some of these markets we may not have been able to get our foot in the door initially without that direct relationship with the seller. But it takes time. You have to be there. You have to spend time with the brokers and the sellers and just the people in the market so they know who you are and understand your story and for us, our HC story and where our equity was coming from. And, it's pretty sticky equity. 1031 exchange equity is sticky. So, we're able to perform. We may not be the fastest, right? Because we have 1031 exchange, but we will always get it done.
Yeah. Well, it's something you said too. You dealt with one seller in some cases, and maybe this one seller had assets in different places and introduced you to that market. That part is huge, just because if that's a significant seller that's unloading their portfolio to you, they recognize you as a performer. The one thing about these deals, the bigger deals anyway, whenever there's a trade, the brokers know. They always know. They reach out to you first.
Yeah, 100%. And that's how we met a lot of the brokers in these markets, right? Because the seller chose us, even though the broker may have had a horse that they wanted to buy the property. But sometimes that's the way we meet these brokers, right? And they see that we've performed. And so, it's worked out for us. So, yeah, it's been a good ride.
So now you mentioned that you had a hard time getting into like Texas and Atlanta. Like what sort of things happened that really held you up from making a bigger splash than you probably could have?
Yeah, I think it's, it's getting your foot in the door, right? We weren't part of the buyers club in Texas, right? We were a California shop that had no experience in the market. So why would a seller want to choose us? Those are the kind of hiccups. I think also, with Texas and Atlanta, especially, was kind of our first jump to the Eastern Seaboard, right? So we needed to make sure that we had our setup in line with Mission Rock, so that we could perform for our investors as well, right? Because it was a big jump for us. It was something new that our investors, didn't know that we were going to do that. So, mainly it was introducing ourselves as a company to these different markets was kind of, if I had to say it down into one sentence, that was probably the struggle we had, both on, being able to buy, but also to make sure that we can operate.
Yeah. And it's funny because whether you are at 20,000 units, 40,000 units, or even just starting off at zero, it's a struggle that everyone faces. It's the same thing as building that credibility in that market. Even for you guys at 20,000 units, it's still tough because, you guys are targeting bigger assets, but there's all kinds of other players out there that are competing, right? That's the key right there.
For sure. And sometimes if we don't have the same broker relationship that the next seller or the next buyer has, we may lose. We may be qualified in every other aspect, but we may lose, right? And that's part of the game. It's part of the real estate game. So we know that, and we know that from the selling side too, right? We sell and we go to market, and so we see both sides of the transaction.
And sometimes it's not always all about price either. It's just to your point. It's if they
no, and execute. Sometimes it's execution, right? Yeah.
And even if they're guarding that relationship too, so maybe they don't want to sell it to you, even if you're at, you're coming in at a higher price. they'll still try to sway that seller to a different deal or to a different buyer.
We've lost a couple deals, even though we were the highest price. So we know that feeling. That's it. Those are tough ones to stomach.
Yeah, that's right. That's right. I'm dealing with something like that right now. I still don't quite get it. That's like, all I do is shrug and wait it out. Maybe it'll come back. Maybe it will. We don't know, right? But yeah, that's,
As long as you know you did all you could, right? Sometimes that has to carry you a little bit. It's like, I did all I could and I still lost. So
that's right. Yeah, and not lose the deal over peanuts. Tripping yourself to pick over pennies, and you could lose out on a huge opportunity of dollars. Yeah, absolutely. So for someone listening right now, maybe they're listening and they're trying to think of maybe what to do with their next step, and when it comes to real estate or even scaling their business and their portfolio, what sort of bulletproof advice would you offer them?
Let's see, out there, I would say invest in real estate, right? If I'm talking to an investor, I would say start small, right? And so there's a couple different ways that you can invest in real estate, right? You can invest in a REIT, or you can invest in a fund, or you can do direct investment. I would say if you can do direct investment, go do it and go learn about real estate and start establishing kind of those little things and learning about all the benefits that come with real estate, whether it be tax-free distributions or the power of 1031 exchanges. I think that side of things is really powerful to know and understand and grow your portfolio. Once you get a direct investment of 2 units, you can turn around in 5 years and turn it into 6 units, right? And then 10 units and 20 units. And so I would say just start doing direct investments in real estate. If you're going to do it, focus in a market first and grow that market. Build your relationship with a property management company and go from there. That would be my advice.
Love it. It's good advice. Take her advice, guys. All right, guys. Well, if you like what Ashlee has to say, go ahead and check out their website at hamiltonzanze.com. Hope you got some insight on how to scale your portfolio. Of course, we're always here to help you guys scale your business. Hope you enjoyed this one. Take care, and I'll see you next episode.